Good morning. Well, welcome to What's Up with the Market. We're going to do a market status update. And as the invitation email said, we are going to talk a little bit about Euphoria today. Haven't done one of these for a while. So got some really good stuff to show you that we don't normally look at, as I did mention in the email. But before we get into it, I want to remind everybody that there's none of this generic technical analysis that I do here, that I cover in this webinar, is used in SPA3 Investor, SPA3 Trader, and I must now add SPA3 Crypto to that as well. And none of this generic technical analysis is used to make any decisions in any of the public portfolios. And I don't use any of this to make decisions in my own portfolios, to whether to buy or sell anything. I'm 100% mechanical, and all I do with my own investing is follow my systems, our systems, Sharewell systems, as you do for at least some of your money. And for that petitioned bit of money, you should be 100% mechanical too. Everything we cover today is general investment advice, and there's no personal investment advice in this webinar or any of the webinars that we do. Right, what I'm going to do is I'm going to just very quickly do a quick public portfolio update, just 3 slides of the, and I'm going to bring Trader into it this time. And I'm doing that because I'm making it's part of the point that I'm going to make, talking a little bit about Euphoria and the parts of the market that are going, and it will align with some of the indices I'm going to show you in this session. And then we'll also talk a little bit about Euphoria, and then I'll get into we'll look back at the past history. We can go back and look at history and see if we've got any pointers or markers that we can learn from by looking back, some 25 years ago or more, 30 years ago, and see what Euphoria really looks like. Okay, let's do the quick public portfolio update. I'm going to start with the Australian public portfolio, SPA3 Investor. Over the last 12 months to a day ago, because I prepared these slides during the day yesterday, the ASX equal weighted SPA3 Investor public portfolio is up 23%. That's a year. That's the year. We do know that was a similar number. I think it is 20% over the financial year, outperforming the ASX 200 accumulation index, which also did 13% around over that period of time as well, and kept going. In fact, it's got a little bit further ahead, 23% over the last year compared to 13% up to date to October. And if we look back over the last 2 years, you'll see that there's only a less than 1% difference between the SPA3 ASX portfolio, the SPA3 Investor ASX portfolio, and that does show that over the last 2 years, the Australian market has done pretty well, and that's a good place to have been in stocks. And what today is going to look at is what parts of the market are going, and how you might rearrange your portfolio. And if I look back over the last 3 years, sorry, not the last 3 years, 3 years ago, 1 year period, 3 years ago, from October 2022 to October 2023. I'm looking in the top right-hand corner over here of this image. You'll see that the ASX SPA3 Investor portfolio actually underperformed and we've spoken a lot about that, underperformed the accumulation index. We went through the sideways market, for 3 years, and just three and a half years nearly. And that return there, nearly all of it was dividends over that period of time, and even over the 3-year period of time where the ASX 200 went sideways from August 2022 to April 2025. Okay, sorry, 2021, August 2021 to April 2025. So we are now getting some growth, and it's a good time to be in stocks in the market. Right, now let's have a look at SPA3 Trader. Now, we don't normally look at SPA3 Trader. This public portfolio is not a real money portfolio. It's continued to be traded. I took this over when Shane took his leave from the business back in March, Aprilish, and I've been managing it since then. And I've got to tell you, that just due to time constraints on my behalf, I trade this 100% mechanically, and I do not look at a single chart when I do my stock selection. All I do is of the stocks that come up that to be traded, follow the exit signals. That's easy, and then the ones to be chosen from there, I purely do to fit position sizes. And if I've got more than one trade to do, I will pick the 2 position sizes from a list that fits into the available capital the most snugly. That's the only, I don't look at a single chart. That's the only criteria that I use. And so over the last year, this is up 38.2%. Now, this is the first clue as to what, and I'll do some more explanation about this in when we get into looking at some of the indices and sectors. But it's really going gangbusters. It doesn't always do that, but it's really symptomatic of the type of market we're in, and it goes to a little bit talking about this question of, are we in euphoria? And if we are, how long might it last? Now, if we go back over the last 2 years, this portfolio is still outperforming the index, the accumulation index, and is also outperforming SPA3 Investor. Now, over the last 10 years, it hasn't outperformed SPA3 Investor. So there are pockets when it does and when it doesn't. And that goes to, it's a different trading system, obviously, in a different whole period, and also is an all of market trading system. So it looks at any stock that's liquid enough to be able to take trades in of the 2,200 odd stocks listed on the Australian market, which typically from a liquidity perspective makes your universe about, it goes from probably about 500, 450 odd stocks, and it can expand in times like this to maybe 700, 800, 900, even 1,000 stocks, because the liquidity doesn't just stay the same. It kind of expands and contracts all the time, depending on what parts of the market are going. So we'll show which parts those are when we get into the sectors in a moment. And then lastly, we will look at the US portfolio, SPA3 Investor US portfolio. And those of you that are trading US over the last 12 months, it has underperformed the index. And it's had fits and starts along the way, and has been tough on the methodology over this period of time. And there's a whole bunch of reasons which I probably won't get into now. We are doing some research in this area, but it just shows that when, and we'll look at that now in a moment, when the Australian market was doing poorly, the American SPA3 Investor was doing very, very well. So over the last 2 years, it's still 10% compounded per annum over those 2 years, October 23 to October 25. So I'm taking really starting from now, going back a year or two. But over the last, that year, 2022 to 2023 that we looked at, where SPA3 Investor was minus 6% compared to the index being 6%, the US market was 17% up in that period, that the Australian market was only up 6%, but the SPA3 Investor portfolio was up 30% over that period of time. So, you're not going to get straight line performance. That's just the way it is with markets and systems and the way it goes. And what you got to do is, you talk about core satellite portfolios. These are all satellite portfolios, and the way that you diversify is through strategies, which is why we have SPA3 Trader and SPA3 SPA3 Investor, and we've added SPA3 Crypto, and we're going to look to add SPA3 in income as well, which would be another strategy, another satellite strategy. So that's just a quick portfolio update that I wanted to provide. And, what's in all, just talking about how strategies, how systems, how the market moves, and pockets of the market move as well. Okay, before I move into beyond charts, I want to talk a little bit about Euphoria. Now, this chart goes back to 1995, so January 1995. And what that is basically the last 5 years of the secular bull market, which ended in round, depending which index you look at, but from January to March of 2000. So that's a 5-year period. And over that 5-year period, the S&P 500 was up 224%, and that is 23.22% compounded per annum. So it did 23% compounded per annum in that last 5 years before the market turned and fell and went into a secular bear market. So this over, you can't see it over there, but it's 26%. So that fall, that first fall, was a 26% fall over 218 days. So on the broader index, I just want to point out to you, because why am I doing this? Because why am I covering this now? Because there's a lot of discussion happening about the markets become euphoric, and and the end is nigh. Henny penny, the sky is about to fall on our head. So I want to start bringing you into the conversation, and now's a good time to do it, because we know, bull markets, the last phase is euphoric. And but we want to start trying to get a handle on how long the euphoria lasts for, what to look at to give us technical indicators, technical signs, if you like, but also to point out that the euphoria is going to last a lot longer than what people believe. And a lot of these analysts and people that are talking about this euphoria that's happening, probably, even if they were around then, I don't think they were investing. But these are people in their 40s and 50s, and I doubt if they were investing in that last 5 years at the end of the last secular bull market. Those of you who were can remember it. And the other thing is that there was, technical analysis was in its infancy then, and very few people were looking at charts. It was all fundamentals and value, etc., etc. But it wasn't that they weren't around, but it's just that computers were hardly around. You think of the late 1990s, when I started this business, only 10% of households had a computer in 1995. So it wasn't accessible, and people couldn't analyze like we do now. But now we have these tools at hand, and we are going to keep an eye on this over the next year, 2, 3 years, because 4, 5, 6, 7 years, however long this secular bull market keeps going for. But we're going to look for the signs, and I'll do that in these sessions from time to time. But we'll also do it in the secular bull market update, which I do a couple of times a year, or every 6 or 7 months. So that fall, that 26% fall, happened over 218 days. So the signs are going to be there. You can see the flattening out. The other thing I want to point out is that when we have a look at the S&P chart in a moment, you'll see that, so this is an ATRVE in the bottom over here, 21-day. That bottom red line is 1% volatility. Sorry, 1%, yeah. So that's the 1% volatility. Just leave it at that for the time being. And the top red line is 3.5% volatility. And the S&P 500 right now is below 1% volatility. But notice how it got more volatile into the trend. Typically, trends, as the trends mature, volatility drops. So here we had a situation of the trend maturing, but becoming more volatile. And that is one sign that we'll be keeping an eye on for a maturing. That's a sign, if you like. One of the signs looking for that is an indication of euphoria. And that fall that went on well into 2008. So 2001, and all the way to 2000, 2001. So we can see at the bottom chart over here, we well into 2001 already, and it started turning at the end of 2002 into March 2003. So that's the S&P 500. Similar chart with the Nasdaq Composite Index. That there is the 3.5% volatility line, so more volatile on the way up. But look how the volatility gradually increased into the trend, and then obviously that volatility dropped. Now that drop there is a bigger drop. That was about 32 or 30 odd percent in a much shorter period of time, about 74 days. So the more volatile index, more volatile fall off. But have a look at this compounded annual growth over here. 44% compounded annual growth over 5 years. So I'm not saying that's what's going to happen this time, but it's an indication of what euphoria really does look like in the charts. And of course, the other one is everybody getting into stocks and talking about stocks. So all these people talking about euphoria, let's come back to the data and just put some boundaries on it, and before we all head for the hills. And look how long that lasted. That's 44% compounded over 5 years. That's a 576% run-up growth, total growth in 5 years. The last one you're going to look at is the SOX, the the semiconductor sector index. And this one did over 800% growth. And then that compounded was 53% compounded per annum. And look at this volatility. It spent all of its time above 3.5%, but you can see a gradual growth of volatility into the trend here. And then, of course, the thing fell. Now, that over here, that was a 30% drop in 34 days. So it looks tiny compared to the rest. So when it does end, it's going to happen pretty quickly. But the other thing to point out is look at these two big drops along the way while the secular bull market was still going. So we are going to have these, and it's going to look and feel like the end. But we are going to just follow our rules. And that's why we want to be mechanical, because we don't know when the thing is going to end. Right. So that's the Euphoria bit. And we'll come back and look at this from time to time. And combined with the secular bull market analysis, we'll just try and keep a gauge on where we might be in the Euphoria. But I don't believe it started yet, or it may just have started, and we'll see where that goes. Right, I'll switch over to Beyond Charts, and we'll get into the, just quickly go through the large international indices. I'll do it a bit quicker today because I've just covered this, but also I want to get into looking at these pockets of the Australian market that are going gangbusters. Okay, Dow Jones, first thing I want to point out, above all-time high in an open trade and is underperforming the S&P 500. First sign that we are in a risk-on environment. We go into the S&P 500. So there's the 1% line. There's a 3.5% line. As I said, it's below 1% volatility and just gone to a new all-time high and just gone back over here. What date is that? That is in June, and has continued to rise as volatility's fallen. Pretty normal stuff in the trend, in between in the channel and rising. So that is definitely a risk on. Have a look at these. I'm not going to. There's no signs over here of divergence in the cumulative new high, new low. So we'll go to the next one. No signs of divergence here either in the cumulative advanced decline line. And there is a divergence. There've been 3 divergences here, and this is telling us the number of stocks that are above their 150-day moving average. And there's been 3 divergences here, but as you hear me say all the time, is that there's no one-to-one correlation between divergence and the market falling. But at the top of every market, you will find divergence. Right, market behaving. Look at this, risk on, been going for some time. That's going back all the way to May. Sell in May and go away did not work this year. And so far, September, October, it hasn't worked either. That the notoriously the 2 worst months, but we still got the rest of October to go. I'm sure there's going to be a little bit of a dip somewhere along the line. But this is the US dollar index. And as the equities rise, dollar index falling, that divergence is exactly what you want. A falling US dollar is good for equities. And the next one we're looking at is the Russell growth versus Russell value. And there's risk on happened back here in May, and it's kept going. So exactly when sell in May and go away should have happened is when we should have been getting into the market. Doesn't always happen like that, but we had a poor April, with the Liberation Tariff Day tariff announcements. So that is definitely risk on, and you can see the outperformance occurring in the growth. And this is consumer discretionary versus consumer staple. Naked Eye tells us that discretionary is doing much better, as does the relative strength line. And there is the risk on back in 21st of May. So all of these are showing that the last line I have here is a green line showing risk on. This is the put call ratio of S&P 500 equities. Look at this, lower highs, lower lows. There was the risk on that came on 24th of April and has continued to fall as the market has risen. Bonds, treasury bonds are also, T-bonds also behaving themselves. The rates, yields are falling. There's risk on happened back in also May and has continued to be risk on from a bond perspective, from bond yields. The actual bonds themselves, and they should go in the same direction if yields are falling, and not quite. There have been some divergences here, but there have also been pockets of when the 30-year treasuries have been rising as well. So that's risk on. The fear index, the VIX, lower lows. You can see the moving average over here is falling as well, just showing that falling, and also in the lower bounds of the ATRV as well. Risk on everywhere. Now we're looking at the Nasdaq Composite. Is the Nasdaq Composite outperforming the S&P 500? Yes, it is. There was risk on back in 22nd of May, and it's continued. Have a look at the Nasdaq 100. Similar thing, risk on back here in 19th of May, and outperformance here of the Nasdaq on the Nasdaq 100 against the S&P 500. So we are seeing we are seeing all of the risk on alignments and indicators here is all aligning. Okay. Sorry, Stephen's asking, Gary, do you have a chart for the euphoria phase on the ASX? No, I don't in this presentation. And it's not really the indication of euphoria being on the ASX, but you will see, I'll take you through some charts in a moment that are not the actual, similar to the S&P 500 that I showed you, but it will, in fact, sorry, just to answer that question, Steve, is back in the last 5 years of the secular bull market in America, the ASX 200, the ASX, the All Ords, ASX 200 only started in the year 2000. So in that 1995 to 2000 time, the All Ords underperformed the S&P 500 dramatically. But we had outperformance in 2002 through to 2006 because of the sectors I'm going to show you today. So it wasn't totally in sync, but we'll get to that in a moment. Right, so this is the NDX. We did that. So let's have a look next at the accumulation of new high, new low. No divergence there. And there is a little bit of divergence in the cumulative advanced decline. So what is that telling us? That is telling us that not all of the Nasdaq 100 are participating in this rise. And that is probably true because there's been a heavy emphasis, if you like, on tech stocks and particularly AI stocks. So that's where that divergence is coming through there. That's the cumulative advanced decline. That's looking at all 100 stocks in the Nasdaq. So if we're a raging bull market and with euphoria full on, is all the stocks will be going up. So you'd see this gray line over here rising like it did over there. Right, looking at those above moving average, there is divergence here, which is something to keep an eye on. But again, it's not all stocks above their 150-day moving average. Right, this is the indicator. This is the semiconductor sector, which I showed you one of the euphoria charts earlier on. It was the third chart, and here you can see risk on happened a bit later in June, 10th of June, and it's outperforming. So this is against the Nasdaq 100. So we have got the semiconductor sector outperforming the Nasdaq 100, which goes a little bit of the way to explain why the cumulative advanced decline line is got a bit of divergence in it. So that's what we're looking at. Everything is outperforming. Now looking at the TSE 60, the Canadian major index, and I've done a February 2025, so around about here, I've actually set this this base reference to compare how the Australian market has done compared to the Canadian market, and you can see the Canadian market, a resource-based market, is outperforming Australia. So it's known for its gold and resources as well. So we are lagging the Canadian market, and I haven't got a chart for it, but we also are lagging the South African market to a degree as well. So this is the All Ords. Now, first thing I want to show you here is that the All Ords is underperforming the S&P 500, which is typically what happens in a risk-on environment. So it feels like we're doing all right, but it is underperforming the US market. What I might do in the session, I'll actually answer Steve's question. I will just go back to we'll go back to 2000. So here we are, 1995 to 2000, and then we'll bring in the period after 2000 as well, and we'll just turn that off. So this is that's 1990. It's probably more from there. Okay, so there's 1995. So you can see this is the market rising. It underperformed the S&P 500 quite dramatically. And we will now just put a profit loss line on here and see what the growth was from that period to that period. And we can see we ran at about 9% compounded per annum. So the euphoria didn't quite happen in the Australian market to the same degree. Towards the latter end of the when the US market started falling, that is over here, we didn't fall as much. Therefore, our relative strength rose a bit, which meant we outperformed. Sorry, I've got it wrong. There's 2000. There's 2000. So it was 10%, 10% compounded per annum, and that was through to March. So about half of the compounded, less than half of the compounded return of the S&P 500, a fifth of the Nasdaq, and an eighth of the Semiconductor index, and that's compounding. That isn't linear. If you actually do that, it won't be an eighth of profit. It'll be even less because of the effect of compounding. But what happened is our fall over here in this period over here was much less in the initial in the part of this at the beginning of the stock of the secular bear market that started in the United States. And this outperformance was because we basically went sideways, to that period over there, and then we started our real growth. And this is where we outperformed. And this period here, which was 2003, so March 2003, the bottom of the 2001 to 2003 bear market, 2000 to 2003 bear market, is this growth over here, which I'm going to talk about in a moment. And where that came from and what could be starting up again. And really is, when I say starting, I mean starting. It could go for a lot longer. So we're underperforming the US market at the moment, but we're still doing pretty well. Aussie Battler is an open trade at the moment. There has been some slow strength against the US dollar. That's because the US dollar is falling. And we'll quickly look at other markets. These are new all-time highs that have been made by the Nikkei and outperforming the US market. And the DAX is underperforming at the moment. It's a closed trade, but some strength coming in just recent trading sessions. The FTSE is at new all-time highs, but is still underperforming the US market. And the Chinese market is falling to matching. Sorry, that's above a SPA. That's the Brazilian market. These are all-time highs up here as well, top right-hand corner. The Chinese market is not all-time highs, lagging a long way behind. And although there's been a lot of talk about the Chinese market rising strongly, it's still slightly underperforming the US market. And that was the large cap, and so are is the entire index, the all share Shanghai index is also going sideways, so it's not outperforming. The Hang Seng, there's been a lot of discussion about the Hang Seng as well, and feeling it's going gangbusters, not outperforming the US market either. Okay, and the South African market, there is a little bit of outperformance of the US market over the last period of time. Quickly onto commodities. CRB index is not going anywhere. I'll get through these pretty quickly because I want to get onto the important stuff. Gold is continuing to make new all-time highs. A little bit of a fall in the last session, but these are all-time highs. And there, gold is during this period of time over here, it actually underperformed the S&P 500 and is now slightly outperforming. So it's equities. In the index and in the US is outperforming gold. Silver is playing catch up. It's been playing catch up since but rather gradually since April of this year. You can see the relative strength line rising. It's playing catch up on gold, which is what it's supposed to do. It's just got to all-time highs. That last all-time high was made in 2010, 15 years ago. So the catch up is happening. The GLD and the SLV ETFs are both open trades and SPA3 Investor. Copper is matching the big fall over there, but this is an all-time high that it got above, and it's making good ground again to get above that all-time high. So there's recent strength in there. Oil is just in this long-term downtrend big wide-ranging long-term downtrend. And here we get to Bitcoin. So Bitcoin made a new all-time high back here in, when was that? That was in July, and has stayed above its all-time high, which is key, and has had this breakout here as well. I don't think I've got an up-to-date database here. There should be another day on here, but anyway, the points are still valid. The Ethereum is banging its head against its all-time high. It would be expected to hit some resistance there, and it's been that the first time it got to these levels was back in March of 2021, so some 4.5 years. So let's keep an eye on Ethereum. Obviously now we've got mechanical signals to trade both of these. Platinum is, I've spoken a bit about platinum, making this, this is the Australian ETF. You can see this clear breakout here. Long-term side, the last time it had these big run-ups like this was in the period of time that I'm talking about. I'm going to talk about in the next couple of indices. That's 2004 through to, 2001 through to 2008. Look at that. There was a 7-year bull market in platinum, and since then it's lower than its previous highs, but it's starting to make some ground here. There's a breakout above these levels, and if it gets to another breakout, then there could be a strong trend in platinum, because platinum also plays catch up to gold. Same in palladium. Palladium had these huge run-ups in the past, and you can see this is the one here back in 2002-3. This is the one in 2008 to 2011, and sideways, big run-up, come down. So there is palladium, well used right across all of industry, is could also play catch up as well. Right, a couple more we'll look at is uranium at these not quite at all-time highs from back there, had a retracement, pretty normal. Uranium is quite in demand at the moment, but the other thing to point out here, this is a relative strength chart against the URA ETF, the uranium ETF, and it's not a tracker ETF. You can see that one outperforms the other, and at the moment URA is outperforming the uranium price quite strongly. This is one that interests Australia, is iron ore, is stuck in this band here between 95 and about 130, 125 dollars. And the last one we'll look at is coal. Coal is fell out of this range and found support there, and we'll see where it goes from here. So coal and iron ore, which are obviously big export markets for countries like Australia and Canada, aren't as strong as some of the other commodities at the moment. Right, what I'm going to do is quickly flip now through the Australian sectors, and this is these are the GIC sectors, the global indexation classification system, and you can just get a very quick idea of which sectors are performing. So the bottom chart here, this shows the relative strength against the All Ords. So this rising blue line means that discretionary sector is outperforming the All Ords. And then I've also got a comparison here against the staple sector, consumer staple. So this is consumer discretionary versus consumer staple. And you can see consumer discretionary is outperforming consumer staple. What does that mean? Well, it means that consumer staple is typically an area of safety. So that's where money flights. There's flight to the consumer staple sector when there's perceived to be weakness and risk off type market environment. So this is telling us that it's risk on in Australia as well, like we saw in the US with the consumer discretionary outperforming staples there as well. Right, this is energy. Energy is going nowhere, so underperforming. This is staples, underperforming consumer discretionary as we saw in the previous chart, and going sideways to down. This is energy. Energy is, here's the bottom chart, is showing it against oil, so pretty much close to oil, but underperforming the all ordinaries. This is financials. So banks have been outperforming for some time now, going back to, September 2023, gradual outperformance of the all ordinaries and at near all-time highs. This is REITs. REITs are been basically going sideways for a while, so no massive outperformance there. This is the industrials, so a little bit of outperformance here against the All Ordinaries, and then now some weakness against the All Ordinaries. The bottom chart here is against the small industrials index. Outperformance a little bit over here, and now underperformance. So we're seeing that the large cap industrials are underperforming the small cap industrials. So now that's a clue. Looking at healthcare, underperformed the All Ords since July of 2022. So for 3 years, we've had underperformance in health. And I know a lot of people buy and hold some health stocks. This is information technology, outperformance there. And there's been sideways to underperformance since, 11/24, so coming up for a year. And the ASX 200 materials, underperformance of materials, a little bit of flattening out and rising over here. So materials, that's large cap materials, ASX 200 materials have been underperforming the market. Telecommunications, basically sideways to falling. Even this run up over here there was a little bit of outperformance of the All Ordinaries, but more or less for a long time now, sideways to underperforming. This is utilities, underperforming as well. So where's all the performance coming from? This is the Small Ordinaries Index. So going back to here, which is 11/21, November 21, you can see all these periods of outperformance with slight run-ups of tiny little pockets of outperformance, underperformance there. And now what's happened just recently from this period over here, July of 2025, so it's recent, right? Very recent, is we are seeing this outperformance now starting to happen. So strong outperformance of the small industrial, I've gone up one, come down, of the Small Ordinaries. So what is the Small Ordinaries made up of? There's the outperformance. What is the Small Ordinaries made up? Well, it's made up of the small industrials. So you can see the small industrials outperforming the All Ordinaries here as well. So there's industrial stocks in the Small Ordinaries, and there are also small resources. So the small resources have been gathering momentum for some time. Let's just go back up and look at, so that small industrials were underperforming and have started outperforming just recently since late June. But however, the small resources have been picking up since end of last year, so a whole year ago, and now have accelerated. So we are seeing the small part of the market really gaining momentum here. And this is the Emerging Companies Index. Now look at this index. If you go back to 2020, so that is 2022, 2023. So this was the run up from 2002 to 2006-07, big outperformance. We had another run up here to 2011. We'll go back up and have a look at the small resources. Look at this run up from 2001 all the way up to July 2008. Another run up. So this is the environment that we may just be seeing the start of in this period of small industrials, small resources euphoria. So when is the Australian market at its strongest? It's at its strongest when there is confidence in the small resources and the mid-cap resources in Australia. That's when it is at its most confident. And we haven't seen this for a long time. And it may only happen, for a period of time every 20 years. And it may just be starting. There's no predictions here. All I'm doing is looking at the charts and picking what's happening. And that is why I showed you the SPA3 Trader performance over the last year, because it was picking up all these stocks. It didn't try and go and look for them. They just happened to find their way into the portfolio because they put their hand up. And that's what happens with mechanical trading. Mechanical trading is you don't go looking for the pockets. The pockets find you just by executing the trades. So that is small resources. And now we'll go down to the emerging companies and look at the emerging companies. Same thing. The gradient is starting to increase, gone to new all-time highs. And what that is showing is confidence in the small cap companies. People don't go here for dividends. They don't go here to buy and hold. They go here to trade, to get growth. And while these parts, these portions, these pockets of the market aren't running, the only way you can get the same kind of volatility is to go to leverage. And you're doing this, you can do this without leverage. Let's have a look at the mid-cap 50. So the mid-cap 50 has been gaining ground over the last year or so and has accelerated recently. And it's not because so much of the mid-cap industrials is the mid-cap industrials that's remained gradual. It's more to do with the mid-cap resources. So the mid-cap resources have picked up and gathered strength as well. So I think hopefully you're getting the message here. This is starting to feel a bit like the 2003, 4, 5, 6 period in the Australian market, where I've spoken to people about this, and people have written about it, is that they thought it would never happen again. And what it does do is it brings confidence into the Australian market. It also brings capital into Australia as well from offshore investors. And that might see a stronger Australian dollar, not due to a weaker US dollar, but because of capital coming into Australia. So I'm not saying that this is a dead cert, it's going to go for the next 4 years. I'm just saying the signs are there that this could pick up. Of course, confidence could be lost in a flash because of something that happens on the planet, but this is something to keep a strong eye on. And now to finish up, the ASX 20 index, which is also measured against the All Ords at the bottom over here, look what it's done. The 20 largest cap stocks in Australia are underperforming the index. So that is a stark contrast of what's happening with the money in the Australian market. And this is this euphoria? It's a sign of euphoria. And what the last really euphoric time that we had in the Australian market happened in the middle of a secular bear market, not a secular bull market, in 2002 and 2000 through to 2000 and the bottom of 2002 or March 2003 all the way through to 2006. So anything can happen. And so what do you do about this? Well, certainly don't suffer from fear of missing out. There'll be plenty of opportunity. What you do need to do though is stay mechanical. Let the stocks find you, and just set up your if you want to set up pockets of satellite portfolios that can take advantage of these. So to sum up and go back to where we started at the very beginning, euphoria. It is not euphoria like we had at the end of the secular bull market in 1995 to 2000. There are some signs, some early signs that it could be. The takeaways are, euphoria persists and lasts. It doesn't just last for 5 minutes or a few days or a few weeks. It lasts for years. And what we need to do is set ourselves up in a way that we can take advantage of it. Because when the euphoria is over and the secular bull market ends, we're going to be into secular bear market, and we're going to have, lots of blood on the streets and all sorts of things going on for a long period of time. And when that starts, the worst strategy to have then will be a buy and hold index ETF. People will just not be able to have the mental wherewithal to get through, the 50% falls that are going to happen. The multiple, at least two that will happen in that secular bear market when it hits. But until then, the way we should set ourselves up, mentally, is not to fear the euphoria, but to take advantage of the euphoria and embrace it, because we are going to have rules in place that when it does end, we are going to be able to go into cash. We're not going to be able to hold on to everything. We're going to give some back, but the little bit that we give back is going to be minute compared to the growth that we're going to get until the merry-go-round stops. So we're going to keep our eye on this as we go. It's if it's anything like the 1995 through to 2000, and it doesn't mean it's going to be 5 years, but the signs are there that this could take off. What are we looking for? More volatility in the indices. We're looking for pockets of the market, where people, take more risk and speculate, like the small industrials, the small and the emerging companies, and the small industrials here in Australia. Right, that is where I wanted to go. We'll take some questions. Tito is asking, hi Gary, assuming we have time to trade either investor or trader, apart from the returns you showed between the two, what else should one consider between choosing which methodology to trade? if switching is now a good time to sell up investor portfolio and start trader. No, definitely not. Definitely not, because we don't know. It should never be an all or nothing. It really shouldn't. And the idea is really to diversify across strategies, so that when the market does what it's going to do, which we can't predict, the strategy comes to the fore automatically without you trying to predict which one to switch to or be in at any given time. It just doesn't work that way. It's why the hedge funds, they don't pick shorting, they don't pick going short or going long. They have their systems and their processes running all the time. Why? I mean, they've spent billions on trying to pick which strategy to apply at any given time. And they've got tens of people working full time on trying to solve that problem, and nobody solved it. So what do? They let their shorting systems run at the same time. Their shorting processes run at the same time, whether that's mechanical or not. There's people looking at it. They've got a process going, and they're looking for shorting. The other team's looking for long trades, and they run simultaneously, so that when the market does what it's going to do, which they can't predict, the one comes to the fore at the time. Now, we don't short. We go into cash. That is our shorting mechanism. But to try and pick and choose a strategy in advance is just a fool's game. It really is. If the guys who are spending billions on trying to solve that problem can't solve it, we are not going to be able to solve it. So the idea is to spread capital, diversify across strategies. And what happens with hedge funds, and now it's been more and more has been proven as the secular bull market has matured and keeps going for the last 13 years, is that the shorting puts too much of a handbrake on the long systems, to the degree that, as Warren Buffett took the 10-year bet and gave $1 million to charity, is that the S&P 500 index beat all of the funds of funds, if you like, of hedge funds. So we don't want to get into picking and choosing strategies. It just does not work. Hopefully that answers your question, Tito. So what do we do then? We allocate a portion of money. And when that portion of money does better with trader than what it does with investor, so be it. But that's why we're going to bring out income, and income will be a fourth strategy. I'm not saying, none of this presentation was given to say, hey, go and start trading trader. I just showed you that trader started getting those huge returns purely because that part of the market kicked in, and they were able to put their hand up to get into the trader portfolio. That's all that happened there. There was no conscious decision to go and make money with trader. It just happened. So hopefully that answers your question. If there are no more questions, we'll end there. We'll follow up on this theme in months to come, and we'll keep an eye on this, because really the main game now is to make hay while the sun shines. If the compounding and the euphoria happens, but to keep an eye, on that end game all the time. It may be months away, it may be years away, we don't know, but we'll keep a vigilant eye on it. Thank you for your time, and as always, I wish you consistent, objective, and peaceful, active investing.